Quick disclaimer. Before we start, this video is for educational purposes only. It is not financial advice. I am not your financial advisor. Always do your own research or speak with a qualified professional before making investment decisions. Now let's get into it. How much do you need to invest to earn $1,000 per month in Canada? Everyone online says you can earn $1,000 a month in passive income easily. But here's the truth. To make $1,000 per month from investments, you likely need hundreds of thousands of dollars invested. Let's break down the real math. No fake promises, just simple numbers. Step 1. Understand the real goal. $1,000 per month equals $12,000 per year. So the real question is, how much money do you need invested? To generate $12,000 per year, that depends on your return. Step 2. The basic math, simple formula. The formula is simple. Required investment equals annual income divided by expected return. That's it. Now let's look at realistic return assumptions. Not fantasy returns, realistic ones. Scenario 1. Conservative dividend investing, 4% yield. Let's say you invest in dividend ETFs, or blue-chip Canadian stocks, that pay around 4% per year. Some Canadian dividend ETFs historically yield around 3 to 5%, depending on the market. If your portfolio yields 4%, to earn $12,000 per year, $12,000 divided by 0.04 equals $300,000. You would need approximately $300,000 invested to generate $1,000 per month in dividends, and that's before taxes if held in a taxable account. Scenario 2, very conservative, 3% yield. Now let's be even more conservative. Say your portfolio yields 3%. $12,000 divided by 0.03 equals $400,000. That's $400,000 invested to generate $1,000 per month. This surprises a lot of beginners. Passive income is not cheap. Scenario 3. Higher yield, 6%. What if you chase higher yield? Say 6%. $12,000 divided by 0.06 equals $200,000. That sounds better. But here's the problem. Higher yield usually means higher risk. It could mean covered call ETFs, REITs, high payout companies, or riskier sectors. And yields can be cut. So higher income often comes with more volatility. Important. Dividends are not free money. If a company pays you $1 in dividends, its stock price usually drops by about $1. Dividends are not magic. They are part of your total return. This is important to understand. Income investing versus growth investing. Now let's compare two strategies. Income-focused investing. Goal: live off dividends. You build a large portfolio, you collect cash monthly or quarterly. You try not to sell shares. Pros: predictable income. Psychological comfort, feels stable. Cons: requires large capital. Yield can be cut, may grow slower over time. Growth-focused investing, total return. Instead of focusing on dividends, you focus on total growth. For example, broad market ETFs tracking Canadian, US, or global markets. Historically, diversified stock markets have returned around 6 to 8% annually over long periods. Not every year, but over decades. If your portfolio grows at 7% annually on average, you'd withdraw around 4% per year in retirement. Using the 4% rule concept, to safely withdraw $12,000 per year, you would still need around $300,000 invested. Notice something? The number is similar. Whether dividends or withdrawals, the capital requirement is large. TFSA versus RRSP. How taxes affect your $1,000. Now let's talk accounts. At a high level, no tax advice here. TFSA, tax-free savings account. In a TFSA, growth is tax-free. Dividends are tax-free. Withdrawals are tax-free. If you earn $1,000 per month inside a TFSA, you keep the full $1,000. Very powerful for income investing. RRSP, Registered Retirement Savings Plan. With an RRSP, you get a tax deduction when you contribute. Investments grow tax-deferred. Withdrawals are taxed as income. So if you withdraw $1,000 per month in retirement, you will pay income tax on it. Your take-home amount depends on your tax bracket at that time. Very important difference. Taxable account. In a regular taxable account, dividends may be taxed. Capital gains are taxed when you sell. So your $1,000 per month may not be $1,000 after taxes. Account structure matters, but it does not eliminate the need for capital. How long does it take to reach $300,000? Let's make this practical. If you invest $500 per month at a 7% average annual return, it could take roughly 20 to 25 years to reach around $300,000. That's long-term investing, not overnight success. If you invest more, it goes faster. If returns are lower, it takes longer. This is why starting early matters. Realistic expectations. Here's what beginners need to understand. $1,000 per month is not small. It usually requires $200,000 to $400,000 invested. It takes time. Markets go up and down. There are no guarantees. Anyone promising fast passive income from small capital is usually leaving something out. The risks you must understand. Before you chase income, understand the risks. Market downturns. Stocks can drop 20%, 30%, even 50%. Your portfolio value can fall significantly, especially during recessions. Dividend cuts. Companies can reduce or eliminate dividends. It happens, especially during economic stress. High yield does not mean safe yield. Inflation. If inflation averages 2 to 3% per year, your $1,000 today will buy less in 20 years. You need growth to protect purchasing power. Income alone is not enough. So, is $1,000 per month realistic? Yes. It is absolutely possible. But it usually requires significant capital, long-term discipline, consistent investing, realistic return expectations. This is a marathon, not a lottery ticket. Final thoughts. If you're just starting in Canada, focus first on building savings, investing consistently, using accounts like the TFSA wisely, keeping fees low, staying diversified. Income becomes easier after the portfolio grows, not before. Soft CTA. If you're a beginner and want to understand how to start investing in Canada, the best ETFs for beginners, how TFSAs and RRSPs actually work. Check out the beginner investing playlist on this channel. Take it step by step. Build slowly and think long term. Because real wealth in Canada is built with patience, not hype.